Investing is a powerful tool for building wealth and securing financial freedom over time. The process of turning a modest amount of money into a substantial sum through smart investments requires understanding the fundamentals, choosing the right investment strategies, and leveraging the power of time. In this guide, we'll explore how to transform an initial investment of $100 into a long-term wealth-building plan, focusing on the key aspects of stock investing, portfolio management, economic trends, and market psychology. Understanding investment basics. At its core, investing is about putting your money to work so that it can grow over time. Instead of letting money sit idle in a savings account with low interest, investing allows you to generate returns, ideally outpacing inflation in growing your wealth. The first step in creating a long-term investment plan is understanding the key investment vehicles available, such as stocks, bonds, exchange-traded funds, ETFs, and real estate. Each investment option carries its own set of risks and rewards, making it essential to understand your risk tolerance and financial goals before diving in. The power of stock market investments. When it comes to long-term wealth accumulation, stock market investing is one of the most powerful strategies available. A stock represents ownership in a company, meaning that when you buy shares, you are effectively becoming a partial owner of that company. Over time, stocks can deliver significant returns, though they also come with the risk of volatility. However, historical data shows that, on average, stocks tend to outperform other asset classes over long periods. The primary ways investors earn from stocks are through dividends and capital gains. Dividends are periodic payments made to shareholders from a company's profits, typically paid quarterly. Capital gains, on the other hand, occur when the price of a stock increases over time, allowing the investor to sell it for a profit. By carefully selecting stocks with strong growth potential, you can increase your $100 investment significantly over the years. Exchange-traded funds as a diversification strategy. While individual stocks offer the potential for high returns, they also come with higher risks due to their volatility. To mitigate this risk and diversify your investment, you may choose to invest in exchange-traded funds, ETFs, which are investment funds that hold a collection of assets such as stocks, bonds, or commodities, and are traded on stock exchanges. They provide a convenient way for investors to gain exposure to a broad range of companies or sectors without having to buy individual stocks. Investing in ETFs with a focus on growth sectors like technology, healthcare, or renewable energy can be an effective way to turn $100 into a substantial long-term investment. The diversification inherent in ETFs reduces the risk of major losses compared to investing in a single stock, while still providing the potential for significant returns as the overall market or sector grows. Market psychology and long-term investment success. Understanding market psychology is essential for navigating the ups and downs of the stock market. Markets are driven not just by fundamentals, but also by emotions, including fear, greed, and optimism. Investors often make decisions based on short-term fluctuations, which can result in buying at high prices during market bubbles or selling in a panic during downturns. Successful long-term investors, however, maintain a disciplined approach, focusing on the long-term potential of their investments rather than reacting to short-term volatility. When you invest your $100 in stocks or ETFs, remember that the goal is to grow your wealth over time. Avoid trying to time the market or making impulsive decisions based on short-term trends. Instead, focus on building a diversified portfolio, staying invested for the long term, and allowing your investments to compound and grow over time. The role of compounding in wealth creation. Compounding is one of the most powerful forces in investing. The concept of compounding is simple. You earn returns not only on your initial investment, but also on the returns that have already been generated. This exponential growth can lead to significant wealth accumulation over time. The earlier you start investing, the more time your money has to compound and grow. For example, if you invest your $100 in a stock or ETF that earns an average annual return of 8%, your investment will grow to approximately $1,080 over 10 years. However, if you reinvest your dividends and allow your returns to compound, your investment will grow even faster, potentially generating much higher returns over a longer period. Building a diversified portfolio. Diversification is a key strategy for managing risk while optimizing returns. By spreading your investment across different asset classes, sectors, and geographical regions, you reduce the impact of any single investment's poor performance on your overall portfolio. A diversified portfolio can include a mix of stocks, bonds, real estate, and other assets, each contributing to the overall growth of your wealth. When turning $100 into a long-term investment plan, diversification allows you to capture growth in various areas of the market while limiting your exposure to any one asset's risk. For example, if you invest in an ETF that tracks the S&P 500 index, you are gaining exposure to a broad range of large-cap companies across different industries. This can provide both stability and growth potential. Economic trends and their impact on investments. An important aspect of long-term investing is understanding how economic trends influence the markets. Factors such as inflation, interest rates, and global economic growth can impact the performance of different asset classes. For example, in times of low interest rates, stocks may perform well as investors seek higher returns. Conversely, during periods of economic uncertainty or rising interest rates, bonds and other fixed income assets may become more attractive. As an investor, it's crucial to stay informed about the broader economic environment and how it may affect your investments. However, while economic trends can provide insights into potential opportunities or risks, it's important to focus on your long-term investment goals and avoid making knee-jerk reactions based on short-term market fluctuations. Maximizing returns through dollar-cost averaging. Dollar-cost averaging is a strategy that involves investing a fixed amount of money at regular intervals regardless of market conditions. This approach helps mitigate the risk of investing a large sum of money at the wrong time, such as during a market peak. By consistently investing your $100 over time, you reduce the impact of short-term volatility and benefit from the long-term growth of your investments. For example, instead of investing the entire $100 in a single lump sum, you might invest $20 each month in an ETF or stock. This allows you to buy more shares when prices are low and fewer shares when prices are high, effectively averaging the cost of your investments over time. Dollar-cost averaging is particularly effective when investing for the long term, as it encourages disciplined, consistent investing regardless of market conditions. Rebalancing your portfolio over time. As your investments grow, the value of different assets within your portfolio will change. Some investments may outperform others, leading to an imbalance in your asset allocation. Rebalancing involves adjusting your portfolio to maintain your desired allocation and risk profile. This could mean selling some of your high-performing assets and reinvesting the proceeds into underperforming or lower-risk assets. Rebalancing is important for maintaining the long-term growth potential of your portfolio while managing risk. For example, if your stock investments have grown significantly, you may want to sell some of those stocks and invest in bonds or ETFs to maintain a balanced portfolio that aligns with your risk tolerance and financial goals.
Tax considerations for long-term investments. Taxes play a crucial role in the overall returns on your investments. Different types of investments are subject to different tax rates, and understanding the tax implications of your investment strategy can help maximize your returns. For example, long-term capital gains, profits from assets held for over a year, are typically taxed at a lower rate than short-term capital gains. In addition, tax-advantaged accounts like IRAs, individual retirement accounts, and 401ks allow you to grow your investments without paying taxes on the gains until retirement. By utilizing tax-efficient investment strategies, you can reduce the impact of taxes on your long-term returns and keep more of the money your investments generate. Turning $100 into a long-term investment plan is not about making a quick profit, but rather about making smart, consistent decisions that set you up for future success.
By understanding the basics of stock investing, leveraging the power of compounding, and diversifying your portfolio, you can turn a small initial investment into a powerful wealth-building tool. As with any investment strategy, patience, discipline, and knowledge are key to success. With a thoughtful approach and a long-term perspective, your $100 can grow into a significant asset that secures your financial future.